You know, when you look at global markets this year, it's kind of been a mixed bag. But there's one market that's just on an absolute tear, and that's Japan. So today, we're going to dig into what's behind this incredible rally. And more importantly, we'll look at these two powerful opposing forces that are locked in this, well, this dramatic tug of war for its future.
All right, let's just get straight to the numbers. The Nikkei index, it's up a staggering 29% this year. I mean, just look at that. That's more than double what the Nasdaq and the S&P 500 have managed. We're not talking about a small lead here. This is a massive, massive outperformance.
So yeah, that really brings us to the big question, right? The core mystery we're trying to solve here. What on earth is fueling this incredible rally? And maybe even more importantly, can it last? Is this sustainable, or is there something hiding under the surface that could just bring this whole party to a stop?
Okay, so to really get to the bottom of this, the source material gives us this really powerful tool called the four-layer analysis. Think of it as a framework that helps us cut through all the noise. It just focuses on four key areas. First, the market's own internal health, then government policy, third is global trade, and finally, that always critical factor, geopolitics.
And boom, this scorecard really tells the whole story in just one glance. So the way it works is, a score of 50 is perfectly neutral, and you can see right away, policy and trade, they're giving the market a nice tailwind, pulling it up. But look at the other side of that rope. Geopolitics is a huge drag with a score of just 40. So what's the result? A composite score of 49.3. I mean, that's pretty much the definition of a stalemate, a perfect tug of war.
All right, so let's start peeling back these layers one by one. First up, let's look at the market itself. How's it actually holding up on the inside after such a strong run?
And what we find is a score of 50.2. That's almost perfectly neutral. So what does that tell us? It means the market isn't really running out of steam, but at the same time, it's not getting dangerously overheated. It's in this kind of stable holding pattern.
And I love the phrasing here, a high-altitude stalemate. It's a great way to put it. The upward trend, that's still there. But that initial crazy euphoria has kind of settled down. The sentiment has shifted from what the source calls overly bullish to something more like calmly bullish. It's kind of like a mountain climber who's made this really fast ascent and is now just pausing to catch their breath at a super high camp before deciding what to do next.
Okay, so moving on to our second layer, policy and finance. And if you remember from that scorecard, this is the strongest positive force that's in the game right now.
But here's where it gets really interesting. Because even inside this positive layer, there's a fascinating contradiction. On the one hand, you've got the Bank of Japan talking about raising interest rates. That's a tightening force, right? That should cool the market down. But then, on the other hand, the high stock prices themselves, plus a historically weak yen, are basically acting like a powerful economic stimulus that's an easing force. So you've got this push and pull happening inside the same layer. So, the million-dollar question is, which side is winning this internal battle? Well, with a score of 55.3, the answer is pretty clear. For right now, the positive, easing effects from the strong market and that weak currency are totally overpowering the worries about future rate hikes. And that, right there, is the single biggest tailwind pushing Japanese stocks higher. All right, let's move on to Layer 3, trade and supply. Basically, how are Japan's connections to the global economy playing out for its market?
And what we find here is, well, it's another mixed bag. So, on the plus side, all those pandemic-era supply chain nightmares, they've pretty much disappeared. And that's fantastic news for Japan's big exporters. But the country is still dealing with a trade deficit. And there's been this really sharp drop in tourism from China, which is creating a whole new headwind for their service industry. So when you balance all of that out, where do we land? The score comes in at 51.5. It's a positive, but just barely. It means the benefits of that smooth supply chain are just outweighing the negatives from the trade deficit and the tourism slump. So yeah, it's a slight tailwind, but definitely not a strong one.
And that brings us to our final layer. And honestly, it's the most dramatic one, geopolitics. This is the clear bad guy in our story, the really heavy weight that's pulling on the other end of that rope.
And there's absolutely no ambiguity here. The source is crystal clear on this. The single biggest negative factor is the rapid deterioration of diplomatic relations between Japan and China. This is creating this cloud of uncertainty that's really weighing on how investors feel.
And that score of 40.0, that puts a number on that risk. It is a significant headwind, and it's actively pulling the overall market sentiment down. This really explains why, even with all those other positive things going on, the market just feels like it's fighting against something. This tension with China, that's the invisible resistance.
Okay, so we've looked at all 4 layers. We've got a calm market, supportive policy, slightly positive trade, and then this really negative geopolitical situation. So, what does this super tense balance actually mean for the future?
Well, according to our source, the most likely scenario, the base case, isn't another huge leap forward. It's more of a holding pattern. The prediction is for the Nikkei to basically trade sideways in a range, somewhere between 51,000 and 53,000. And this perfectly reflects that stalemate we've been talking about. The market is strong enough to hold its ground up here, but it's just facing way too much of a headwind to climb much higher, at least for now.
So really, we're looking at 2 potential paths forward. The most likely path, that base scenario, is that the market just continues this high-altitude tug of war. But there's a pretty big risk scenario to watch out for. And that is, if those geopolitical tensions get even worse, foreign investors might start getting nervous. They might see Japan as too risky and start pulling their money out. And that is the kind of event that could break this stalemate and send things downward.
Okay, let's bring this all home. What does this all mean for you? Look, Japan is one of the world's biggest economies, so what happens there definitely doesn't stay there. This matters to global investors and really the whole economic landscape. So what's the big takeaway from all this?
This slide really wraps up the whole story perfectly. You've got the fundamentals and financial conditions acting as a slight tailwind, but geopolitics is a clear, strong headwind. Market prices are high, sure, but nobody's getting overly optimistic. And the result is what the source calls a jikusen, which is a Japanese term for a war of attrition, a long, grinding fight happening at a really high altitude. So with that in mind, the suggested approach here isn't to go all in or to run for the hills. It's about being selective. The source suggests maybe focusing on themes that benefit from Japan's own domestic demand, things like wage growth and capital investment, and also to consider those export-focused companies who are still benefiting from that weak yen. But the most crucial piece of advice? Use time diversification. In other words, don't just dump all your money in at once.
And so that leaves us with this one critical question. You have this rope stretched incredibly tight. On one side, you have supportive fundamentals. On the other, you have the heavy weight of geopolitical risk. The future of the Japanese market is literally hanging in the balance. The only question left is, which side is going to pull harder?